Hello, everyone. My name is Nevin Akaydın. I am a librarian at Santa Clara City Library. Today, I am with Alessandra from Habitat for Humanity. Thank you, Alessandra, for being with us today. I am really excited to hear information on shopping for a mortgage loan. Thank you.
Yeah, thank you, Nevin, for having me. I'm happy to be here. Welcome, everybody, and thank you so much for joining us. And welcome to our Shopping for a Mortgage Loan presentation. I'm going to skip the slide because this is for our regular presentation about the handouts, but Nevin already mentioned that she uploaded those handouts. So, but I would like to tell you a little bit about who we are. We are a nonprofit. Habitat for Humanity East Bay Silicon Valley is a nonprofit, and we serve people in Alameda, Contra Costa, and Santa Clara counties. Now, our organization is a HUD-approved housing counseling agency. So what that means is that we offer a variety of programs and services that help people achieve financial fitness. And our services include one-on-one counseling, financial education workshops like the one we're presenting today, online financial education, and first-time homebuyer classes. With one-on-one counseling, we offer free individualized guidance by a HUD-certified housing counselor. And this is available to anybody who would like to learn how to manage their personal finances, including how to create a sustainable household budget, balance income and expenses, start a saving plan, manage debt. We also offer credit counseling, which teaches how to build or rebuild a positive credit history. And we also offer home pre-purchase counseling, and that's to help people understand how the home buying process works and how to become financially ready to purchase a home. We offer a variety of financial education webinars like the one that we're presenting today on a wide range of topics. And we post those webinars. We offer them monthly. We post them up on our events page, and a online financial education center. Now, this is a free online library of interactive lessons that are available to you 24/7. I'll talk to you more about this at the end of the presentation. And we also teach the HUD-approved first-time homebuyer class. Now, in addition to being a HUD-approved housing counseling agency, we also offer affordable homeownership opportunities where we build new homes and renovate existing homes, and then we sell them at an affordable mortgage to qualified families with limited and moderate incomes. And we also offer home repair services. So to learn about all that we offer, please visit us at www.habitateBSB.org. But today we're going to be covering shopping for a mortgage loan, the cost of borrowing, the mortgage loan application process. We'll go over the loan estimate briefly, give you an overview, and then comparing loan offers. And then we'll talk also about escrow accounts. Now, before you apply for a mortgage loan, there are steps you should take to prepare. The first step is to take a HUD-approved first-time homebuyer class. This is an 8-hour course that reviews the home buying process. Now, many borrowers take this course as a lender requirement to qualify for a particular loan or assistance program, and this is often at the end of the home buying process when they're about to close. A better strategy is to take it early on before you start shopping for a home. Now, owning a home is expensive. You'll have costs that you don't have as a renter, like property taxes, homeowner insurance, repairs and maintenance, HOA dues if your home is in a homeowner association. So it takes time to strengthen personal finances before buying a home. So to start, review your household budget to know how much you can afford to add in housing-related expenses. Make sure you have enough savings available to cover the upfront costs, like the down payment and closing costs. If you owe debts, like collections, pay them. Outstanding debt is a red flag for lenders. It may prevent you from qualifying for a loan. If you have high credit card debt and your finances allow it, start paying it down to reduce your debt load. And don't take on a new debt, because when you apply for a loan, lenders will look at how much debt you're currently carrying. to decide whether or not you can qualify for the loan. The lender will require you to provide credit references. So typically these are derived from credit report. However, if you don't have a traditional credit history and just starting out to build one, then start gathering non-traditional credit references and be ready to provide them. These are accounts that contractually require you to make regular monthly payments. It could be your landlord for your rent payments, your cell phone company, utilities, car insurance if you pay it monthly. Start researching and understand your options. There are various home buyer loan and assistance programs that help home buyer purchase a home. So before you speak with lenders, understand what's available and what be an option for you. And for example, do you want a conventional or a government insured loan? How much can you afford as a down payment? There are loans like FHA loans that only require 3.5% down. Others, like USDA loans, don't require a down payment at all. So if you are considering programs like FHA or USDA, then start checking their list of approved lenders. There are also local, state, and national home buyer assistance programs that provide loans to help cover down payment and closing costs. Cities and counties, many offer home buyer assistance programs designed to help people who live or work within their boundaries purchase a home. Some programs help people who work in specific professions. For example, HUD offers the Good Neighbor Next Door program to help teachers, firefighters, police officers, and EMTs purchase a home. Talk with the lender and get pre-approved. The pre-approval process will give you a home price range that you could afford so that you can target your home search to your price level. It also helps make you a more desirable buyer because it shows that you have a lender who would be willing to lend to you under certain conditions, pending, of course, further confirmation of details. Now, sellers may also require it before accepting an offer on their house. And this is especially common when the market is hot. Make a list of 3 potential lenders. When you're ready to apply for a mortgage loan, get more than one offer so you can compare and choose the one that's best for you. You can start with the bank or credit union you already have a relationship with. You can ask for recommendations from people you trust. You know, ask them why they like working with a specific lender or mortgage broker. Now, the pre-qualification and pre-approval processes both help you assess how much home you can afford, but there is a difference between the two. Pre-qualification is an informal evaluation and can be a helpful step if you're at the very beginning of the home buying process and you just kind of want to get a sense of a purchase price that would be affordable to you. It's based on verbal information about your income, your assets, and non-documentation is required. Now, depending on the lender, a credit review may or may not be required. With a pre-approval has more weight. The lender makes a conditional commitment to grant you a loan. Typically, you would go through this process if you're actively shopping for a home, but have not yet found one and that you want to purchase. So in this case, you provide documentation. Now, every lender is different, so you need to find out what you need to do and what they require. Then the lender makes a conditional pre-approval based on actual verification of income, credit, and assets, and through a review of bank statements, pay stubs, tax returns, W-2s. They will also check your credit report. And then you receive a pre-approval letter. These letters aren't guaranteed loan offers, and you're not committing to working with that particular lender, but they let the home seller know you are a serious buyer, just like I mentioned a little bit earlier. The letter will say how long the conditional approval is valid for and will include conditions. For example, that the home's appraisal value meets the agreed upon purchase price. Now, keep in mind that pre-approval letters generally expire within 30 to 60 days, so get your approval no earlier than 1 or 2 months before you plan to start looking for a home to buy. And also keep in mind that not all lenders offer these letters. Now, mortgage loan is a loan against a property that the home buyer pays back over a set number of years. It is legally binding contract that allows the lender to have a claim to the property should the borrower stop making payments or not follow the terms of the contract. Now, there are 2 main types of home loans, conventional and government insured. All are issued by banks, credit unions, and approved lenders. However, there are some major differences. Conventional home loans, because they're not government insured, pose a higher risk for the lender. So credit and income requirements are stricter than government-backed loans. Now, these types of loans are an option for borrowers with a good or excellent credit and who can make a larger down payment. A government-insured loan is backed by one of three federal government agencies: the Federal Housing Administration, or FHA, the U.S. Department of Agriculture, or USDA, and the Department of Veterans Affairs, or VA. With these types of loans, the government agency is not the direct lender. The agency promises to repay the lender if the borrower fails to do so. So the lender's risk is reduced. And for this reason, the lenders are more willing to approve loans in situations when a borrower might not otherwise qualify. These types of loans have strict credit requirements, and minimum required down payment is lower. And to qualify, the home buyer must meet the program's guideline requirements and must also work with an approved lender. When you get a mortgage loan to help you purchase a home, the loan is recorded as having the first repayment priority after closing. This means that if you sell the home, refinance it, or default on your loan, it will be the first debt that must be repaid. Behind this primary loan, a buyer may have a secondary, or also known as subordinate mortgage loan, that's used to help buy the home. Examples of subordinate mortgages are down payment or closing cost assistance loans. Now, payment priority for a subordinate mortgage is based on their position. For example, a subordinate mortgage in third position would be paid only after the first and the second mortgages are paid in full. If the value of the home is not enough to cover all the loans on the home, the mortgages that are in lower priority position are less likely to be paid back. And so for this reason, the lender is taking a bigger risk, and interest rates are typically higher than a first mortgage loan. Now, subordinate mortgages could be forgivable. For example, some down payment assistance programs allow for the loan amount to be forgiven if you live in the property as your primary place of residence for a set number of years, and could also include the right for the lender to be entitled to a percentage share in the appreciation of the home's value. So what that means that if you sell the home or refinance the mortgage, you pay back the loan amount plus a percentage of the home's appreciation, if any. So for example, if you borrow 10% of the purchase price through a down payment assistance program, when you sell or refinance, you would pay back the amount you borrowed plus 10% of your profit. Now, if you take out a subordinate mortgage loan, it's important that you understand all the terms. Is it repayable? When? What is the interest rate? And what will the monthly payment be? Is it forgivable? If yes, when? Does it include an appreciation share? Now, whenever you borrow money, you will pay interest, of course. The interest rate is the annual cost you pay the lender each year to borrow its money. It can be fixed or variable. It's expressed as a percentage and does not include fees or charges associated with the loan. The rate is determined by a combination of factors, including the state of the economy and personal factors like your credit score and the size of your loan. With a fixed rate loan, the interest rate does not change for the life of the loan. That means that the mortgage payment stays the same as you pay it back. The payment for property taxes, homeowners insurance, and HOA payments will vary and typically increase over time, but not as much as rent can and not as often. And so it will be easier to budget for housing costs. With an adjustable rate mortgage loan, also referred to as an ARM, the interest rate is fixed for a set number of years. And once that initial period ends, then the rate starts adjusting periodically throughout the life of the loan. The annual percentage rate, or APR, is also expressed as a percentage and reflects the interest rate plus the fees you pay the lender to get the loan. For this reason, the APR is higher than the interest rate. Lenders may quote you the same interest rate, but charge different fees. So comparing one loan's APR against another loan's APR will give you a fair comparison of how much each loan will cost you overall. Let's talk a little bit more about that adjustable rate mortgage. So the advantage to an ARM loan is that you lock in a lower interest rate that introductory period. Lower than you will vary and be less stable, and it could also become less affordable because interest rates could go up. So here's an example of an ARM loan. Let's say this borrower is looking into a 7-1 ARM loan. So what that means is for the first 7 years, the interest rate is fixed. And after 7 years, the interest rate will start adjusting every year. Now, in this case, if the borrower knows that they will be moving and selling the home in 7 years, a 7-1 ARM loan might make sense for them. However, this can still be risky because plans can change. Maybe after 7 years, they decide they want to stay in the home, or maybe they want to sell it, but the market is in a downturn and homes don't sell easily, or would lose money if they sold it. Now, if they end up keeping the home, their monthly mortgage payment will now vary from year to year. Depending on the fluctuation of the interest rate, the payment could decrease, but could also increase. In addition to risk ending up with a payment that's less affordable, it would also make budgeting for housing costs more difficult. They could decide to refinance with a fixed rate mortgage, but that means having to pay closing costs. Also, if the interest rate is higher than when they first took out the loan, they would end up with a higher monthly payment for the life of the loan. So before you take out an ARM, make sure that you still will be able to afford the monthly payment if the interest rate increases, and make sure you understand the loan terms. How high can the interest rate and monthly payments go with each adjustment? How frequently will the interest rate adjust? How soon could the payment go up? Is there a cap on how high the interest rate could go? Is there a limit on how low the interest rate could go? Now, you pay for a mortgage loan in 2 ways, upfront and over time. When choosing a mortgage, it's important to look at both. Upfront costs include the earnest money. This is a deposit a buyer pays to show good faith on a signed contract agreement to buy a home. The money is held by a third party, like a real estate broker or a title company. And if the home sale is finalized or closed, then the earnest money may be applied to closing costs or the down payment. If the contract is terminated for a permissible reason, the earnest money is returned to the buyer. If the buyer does not perform in good faith, then the earnest money may be forfeited and paid out to the seller. Buyers also have to put some of their own funds towards the purchase of the home. This is known as the down payment. The lender provides the rest of the money to buy the property in the form of a loan. And then again, depending on the loan program, the minimum down payment required can be anywhere between 3% to 20% of the purchase price of the home. Closing costs are the expenses that home buyers pay when they close on the purchase of a home or property. These include costs like application, attorney, underwriting, processing, and administrative fees, and total cost ranges between 2% and 5% of the property's purchase price. There are prepaid expenses that you may need to pay at closing before they're due. For example, typically you need to pay the interest on your loan between the time you close and the end of that month. It's also common to pay the first year's homeowner insurance premium and make initial deposits into an escrow account to cover future homeowners insurance property taxes. And we'll talk about escrow accounts a little bit later. Now, the monthly mortgage payment is typically made up of 4 components: the principal, the interest, taxes, and insurance. Now, this payment is referred to as the PITI. The P refers to the principal. That's the portion of the payment that goes toward repaying the borrowed amount. The I refers to interest. That's how much the lender charges the borrower for lending the money. Property taxes are the property payments collected by your local government. How much you pay is based on the home assessed value and the local property tax rate. The lender will take the annual amount due divided by 12 and then add that amount to the monthly payment. 2 main types of insurance can be included as part of your mortgage payment. Homeowner insurance is required, financial protection. You must maintain it in case your property is damaged by fire, wind, theft, or other hazards. But depending on your geographic location, you may be required to get additional flood insurance. Just like property taxes, the lender will take the annual amount due divided by 12 and add that amount to the monthly payment. Mortgage insurance protects the lender in case you fail to repay your mortgage. If you put less than 20% as a down payment, you will be required to pay it. And some loan programs also require an upfront payment in addition to the monthly payment. If the home is in a development that has a homeowner association, your monthly payment obligation will also include the cost of the HOA dues. This is when the PITI is referred to as a PITIA. You also may have to pay special assessment fees periodically. These are unusual fees that the HOA may require homeowners to pay in addition to the regular monthly payment. Although this payment does not go to the lender, you still must make sure that you're taking it into consideration and that you can afford it. Now, here are some of the people who are involved in the home loan application approval process. A mortgage lender is a financial institution that makes loans to a home buyer and includes banks and credit unions. Lenders must make a good faith determination that a consumer can afford the mortgage. They also must be transparent with loan cost information, fees, and payments. They offer their own loan products, so the choices may be limited. So for example, they may not offer programs like government-backed loans. A mortgage broker does not lend money. They work with several lenders. They act as an intermediary between the borrower and the lender. They help the home buyer shop around for a loan, compare loan options, and guide them through the qualification and loan approval process. Mortgage brokers charge fees, which is paid in the form of a commission or other payment from the borrower or the lender. Some financial institutions operate as both lenders and brokers, so you should ask whether a broker is involved in your loan transaction. You also want to make sure they're licensed brokers. Whether you use a broker or a lender, you should always shop around for the best loan terms and the lowest interest rates and fees. A loan that may seem reasonable at first may not be your best option when compared to other offers. So ask questions to help you get a better sense for what kind of loan might be the best choice for you. The loan officer, sometimes known as the loan originator, gathers documents, comes up with financing options that meet your financial capability, and helps you complete the loan application. The loan processor reviews your documentation and makes sure the loan application packet is complete to present to the underwriter. And the loan underwriter reviews the loan application and documentation and assesses if you're eligible for the loan you're applying for. They approve or reject a mortgage loan application based on credit, employment history, assets, and debts. So when you talk with a lender about applying for a mortgage loan, you'll start by discussing the type of mortgage you are interested in. So again, talk to more than one lender, ask for the same kind of loan with the same features, and compare loan offers so that you can decide which lenders offer the best deals. Your loan application will go through several steps. First, you complete and submit your loan application with your supporting documentation, including documentation like driver's license, social security number, proof of income, like your most recent pay stubs, the last 2 years of tax returns and W-2s, profit and loss statements, and 1099s if you're self-employed, benefit payment letters if you're receiving assistance like disability or social security, your most recent 2 to 3 months of bank statements, all pages, including blank ones, your credit report, which the lender will pull on your behalf, and a copy of the purchase contract. You will very likely need to submit updated documents throughout the loan application process, so make sure that you're keeping them up to date and ready to submit when needed. No later than 3 business days after the lender receives the loan application, they must provide you with a loan estimate. This is a 3-page form that clearly shows important details about the loan. Now, to receive it, the loan application must include 6 pieces of information: the applicant's name, income and social security number, property address, an estimate of the value of the property, and the anticipated loan amount. The loan estimate is not a commitment to lend, but it shows you what loan terms the lender expects to offer if you decide to move forward, and spells out the loan's costs, interest rates, and features. Loan estimates are not binding, and you can get them from multiple lenders, so you can compare loan offers to be able to choose the one that's best for you. Now, once you have submitted your loan application, the underwriter will review all your documentation to decide whether or not to approve the application. They'll review your income to calculate how much you earn and to see if you can afford the monthly payment. They will check your employment history. They'll see if you've held the same job or worked in the same field, or do you jump from job to job, industry to industry. If your employment history is not stable, they'll regard it as kind of a risky behavior and red flag. They'll also review your credit report to check your credit history. They're looking to see if you pay bills on time and if you paid as agreed. For example, they'll make sure you don't have any late payment history or maybe outstanding debts like collections. They also look for credit references. These are accounts listed on your credit report that have at least a 12-month recent positive history. Lenders also typically have a minimum credit score requirement that you must meet to be approved for the loan. So they'll check your credit score. And from the credit report, they'll also look at how much debt you currently owe. For example, do you have credit cards with balances, loans like a car or a student loan? And then they will use this information to calculate your debt to income ratio, which is the percentage of your gross monthly income, and gross is your income you earn before taxes or deductions are taken out, that would go towards paying the new housing payment, plus the monthly payment you're already required to make on your current debts. Now, lenders have a maximum total debt ratio requirement, typically 43%. That means that no more than 43% of your gross monthly income can go towards paying all your monthly debts, the new housing payment plus your current debts. And that's to make sure that adding the housing payment to your current debt load will not put you over the edge. They'll also review your bank statements to make sure you have enough in liquid savings to cover the down payment and closing costs, and that you will have a saving reserve after covering them. The amount of reserves needed vary lender by lender and loan type. They are measured in months, meaning the number of months of housing costs that you'd be able to cover with your savings. Now, once you have a loan estimates from different lenders, then you can use them to compare loan offers so that you can decide which lender offers the best deal on the loan amount and any kind of loan you selected. Loan estimates are just that, estimates. They're not set in stone. If you're more comfortable with a certain lender, but another lender gave you a better offer, you could go back to your preferred lender and negotiate your estimate. Once you've made your decision which loan offer to accept, you let the lender of your choice know that you accept the loan offer and want to proceed with the loan application. Now, if you don't, they'll assume you're not interested. The lender is only required to honor the terms of the loan estimate for 10 business days. So it's important that you notify the lender within those 10 days. Once you've selected a lender, you'll provide additional documentation and pay an application fee. Now your application will go through more review. They'll appraise the property to make sure the value of the home you're buying does not appraise lower than the purchase price, because if it does, then the lender is not protected and will not approve the loan at that amount. You'll need to renegotiate or walk away in that case. If you put less than 20% down, you'll also go through a mortgage insurance approval process, which may include both lender and the mortgage insurance company approval. And additional documentation and information may also be required. So for example, they may want employment and income verification, or things like child support and alimony court orders, employer's verification of income. If your bank statements show unexplained large deposits, you may need to provide verifications to show the origin of the deposit. And that's because the lender wants to know, was it a gift or was it a loan? Is there an undisclosed source of income? Some loan programs allow you to use gift funds to help pay for a down payment and closing costs. If you are receiving gift funds, you'll need to provide a gift letter confirming it is a gift, not a loan, and proof that the funds are available. After all, yeah.
We have some timely questions.
Okay.
If you want to answer them.
Sure.
First, are we able to access the slides?
Oh, yes, I'm happy to send you the slides.
Okay, then I will share them with email after the program. So one question about getting a mortgage. Do retirees without a working income have a harder time getting a mortgage?
No, it really boils down to how much you earn. So they'll take a look at what kind of retirement income you're getting and the kind of home you want to buy, and then they'll see whether or not your income can sustain the purchase, buying that home.
Okay. When I was shopping for a mortgage loan, I couldn't see much of a difference between the two companies I got offers from and ended up choosing simply because one was more local than the other. Are there normally significant differences between mortgage loan offers?
Yeah. I mean, there could be not a lot of difference, and then yeah, in that case, you just go with the one that you're more comfortable with. But it's still good to shop around and compare because you never know.
Okay. Does the income include only base salary or unvested shares?
Well, they will, yeah, income from investments, they will probably, it kind of depends on the situation, whether those would be included or not. It depends what kind of income from investment it is. Is it dividends? Are they distributed regularly? So it kind of depends.
Okay. Who is responsible for home appraisal, home buyer or homeowner?
For the home appraisal, the lender will do that. And the buyer will pay the cost for the home appraisal. It's
Okay.
one of the closing costs.
If we have two mortgage loans already, can we have a third loan?
I mean, you can add a third loan. You just, yeah, I mean, you can. It just kind of, you'd want to be careful that you're taking on. I mean, it's another loan that you owe and another lien on the home. So, you want to be careful. But yeah, you can add subordinate mortgages to your original loans.
Okay, thank you. We covered the questions, so we can continue and we will answer other questions at the end. Thank you.
All right. Yeah, of course. All right. So after all the reviews complete, the loan will be either approved or denied. If it's approved, you get a commitment letter. This is different from a pre-approval letter. It states the amount, the terms of the loan, and the conditions of approval. Now, these letters also expire, and it varies from lender to lender, but usually they're valid for 90 days. All right, we just have a quick knowledge check. You can go ahead and chime into the chat box. Now, question number 1, for budgeting purposes, is it better to get a fixed rate loan or an adjustable rate loan?
This is kind of a knowledge check. Just type them in Q&A.
Yeah, just go ahead.
Box.
Do you think for budgeting purposes, is a fixed rate loan better than a adjustable rate loan, or which is better, fixed rate loan or adjustable rate loan?
I see two in Q&A. You can type them in chat, but I see fixed.
Fixed, yes,
yes.
absolutely, yes, it is fixed.
Yes.
All right, another question. Earnest money. Tell me if this is true or false. Earnest money is a payment the buyer makes when making an offer to show they are serious.
Please type your answers in chat, not Q&A, that we can see them easily.
So earnest money is a payment the buyer makes when making an offer to show they are serious. Is that true or false?
Oh, is this a chat disable? That's interesting. I can enable it. So true. I see a lot of true.
True.
So let me enable this.
All right. One more question. The annual percentage rate, or APR, again, this is a true or false, reflects the interest rate plus the fees you pay the lender to get the loan and can be used to compare loan offers. Is this true or false? I'm seeing a lot of truths.
Truths, yes.
Yeah. Okay. Okay. Which housing costs, last question, which housing costs can the lender include when they calculate the monthly payment. Remember, we talked about that PITI, which can become a PITIA. So there's several costs that they can include when they're calculating your monthly payment. What are those payments? All right, so it's the PITI. So think of the first letters.
Someone said PITI.
Yes, PITI. So, but what do they stand for? So PITI stands for P is the principal that you're paying back. I is the interest you're paying to borrow that money. T is taxes, and that's property taxes. I is insurance, which is homeowner insurance and could be mortgage insurance if you put less than 20% down. And then if you also have HOA dues, then that amount will also be included in the calculation to make sure you can afford that payment. Okay, thank you for participating. All right, I'm going to play a video now. This is a video from the Consumer Financial Protection Bureau that explains the know before you owe mortgage disclosure. So I'm going to play the video now.
Taking out a mortgage loan to pay for a new home is one of the biggest financial decisions of your life.
The mortgage process can be complex and confusing, but a new rule from the Consumer Financial Protection Bureau makes it simpler.
We want you to avoid costly surprises and know before you owe.
For most mortgages, the new rule replaces 4 old disclosure forms with 2 new ones, the loan estimate and the closing disclosure. The new forms are easier to understand and easier to use. The new rule also gives you 3 days to review your paperwork and ask questions before you close.
When you apply for a loan, you'll get a loan estimate. This form helps you understand your options and choose the loan that's best for you. Consider applying for loans from at least 3 lenders so you can shop around and compare different loan estimates before choosing a mortgage.
When you're ready to close, you'll get a closing disclosure. This form helps you avoid costly surprises at the closing table. Compare your loan estimate to your closing disclosure to see if the offer has changed.
For help when you're reviewing your new forms, visit our interactive feature that explains the forms. You can get definitions for financial jargon and see what to look for on each page.
The CFPB has tools and information to help you shop for a mortgage. Check out Owning a Home, an online resource where you can review loan options, explore interest rates in your area, follow our closing checklist, and more.
The CFPB is a government agency that protects consumers. The Dodd-Frank Act required us to combine the 4 old forms into 2 new ones, and we set a goal to make the mortgage process easier for you.
You have the right to compare offers and understand the terms before you sign on the dotted line. And the information you're given should be clear and easy to understand.
After 4 years of testing and work, these forms and tools will help you shop for the best deal and avoid costly surprises.
The mortgage process is easier when you know before you owe.
So the Consumer Financial Protection Bureau really is a wealth of information. I encourage you to visit their website, and their interactive loan estimate and loan disclosure are really super helpful. Go take a look, because speaking of which, this is the loan estimate. We'll kind of go over a few things. Now, the page 1 of the loan estimate is an overview of your loan terms and cost. It includes things like the loan terms. Is it 30 years or is it 25 years, 15 years? Now, keep in mind that a shorter loan term will have lower interest rates, but the monthly payment's higher. It also shows you the loan type, this whole section here. Is it a conventional loan or a government insured? Is there a rate lock? Some lenders may lock the rate, but some may not. It would also give you the projected costs of the loan, including the principal, the interest portion of the mortgage payment, mortgage insurance, property taxes, homeowner insurance monthly cost, and the estimated amount that you will have to pay upfront, including your down payment and closing costs. Now, page 2 breaks down the cost on the first page and includes information like, I don't know why my pointer is not working. I apologize, but we're on page 2 now. Things like points. These can be origination points, and origination points. Well, there could be discount points. Discount points are prepaid interest on the mortgage loan. The more points you pay, the lower the interest rate you'll have. Now, whether you should pay them or not really depends on your financial situation and how long you plan to keep the home. For example, do you have enough savings to afford that extra cost? And will you recoup the money if you paid up front? Origination points is the fee the lender charges to make the loan. Now, this page also includes services you cannot shop for. The lender sets these costs and include things like the credit report and appraisal fees. It also includes services you can shop for. These are third-party services. They're not set by your lender, and you're free to shop for cheaper third-party providers. It will include prepaids. These are the upfront cash payments that you make at closing for certain mortgage expenses before they're actually due, including homeowner insurance and interest. And then page 3 has key information that helps you compare the loan offer from different mortgage lenders, and that includes the 5-year costs of borrowing, which tells you how much you'll have paid altogether and how much you'll have paid off toward the loan balance in 5 years. And also the APR, which will show you, which will help you compare. Remember, I talked about it earlier. It'll help you compare how much that a loan from one lender will cost you compared to another lender, because it includes not only just the interest rate, but also the fees that the lender charges. Again, the CFPB has an interactive loan estimate explainer where that has drop downs for each section and will kind of explain how to understand each section. So I encourage you to take a look. Now, there are several factors to consider when you're choosing a loan. For example, the cost of the loan, your comfort with the loan officer's ability to answer your questions, and your confidence that the lender can meet your closing timeframe. Compare the loan details of the various estimates to see how they stack up against one another. Is the interest rate fixed or adjustable? Is it locked? If yes, when does it expire? The monthly principal and the interest payment. Mortgage insurance cost, will you have to pay it? And what is the monthly payment? Does it go away? And if yes, when? Will you have to pay upfront costs? Compare the APR so you can see how much each loan will cost you overall. Compare the 5-year cost of borrowing as shown on page 3 of the loan estimate. Figuring out the total dollar amount you'll pay in interest and fees over 5 years is a good way to compare loan offers. Compare the closing costs and what the minimum down payment requirements are. And when comparing loan estimates, know when you are comparing apples to apples and when you're comparing apples to oranges. So for example, do they all have the same kind of loan with the same feature? For example, a fixed rate mortgage is different than an adjustable rate mortgage. When were they issued? Interest rates can change daily. So a difference in rate between two lenders may be due to market changes if they were issued on different days. Do they use similar numbers for estimated taxes and insurance? If one loan estimate shows lower taxes and insurance, that doesn't mean the loan is a better deal. Lenders don't control your taxes and insurance. You can ask your real estate agent to help you figure out which set of numbers is more realistic. Now, an escrow account is set up by the lender and is typically used for two reasons: to protect the buyer's good faith deposit, so the money goes to the right party according to the conditions of the sale, and to hold the homeowner's funds for property taxes and homeowner insurance to make sure those bills get paid. Generally, a lender will require an escrow account for home buyers who put less than 20% down as a down payment. So here's how it works. Let's say that this homeowner's monthly principal and interest payment is $1,200. That's their mortgage payment, the amount that goes towards paying back the loan. The yearly property taxes are estimated to be $3,000, and the yearly homeowner insurance is $1,200. The lender now calculates the monthly payments this homeowner must make to ensure those full amounts are available and the bills are due. So they take the 2 annual costs and divide them by 12. That means the homeowner must pay $250 a month towards property taxes and $100 a month towards homeowner insurance. In addition, the home is in a homeowner association and the monthly dues are $250. So that means that this homeowner must pay a total $1,800 a month to cover all these costs. $1,550 for the PITI payment, plus $250 for the HOA dues. So when the homeowner makes their monthly payment, they will pay the $250 HOA dues directly to the homeowner association, and then $1,550 PITI payment amount to the loan servicer. When the loan servicer receives the $1,550 payment, $1,200 will go towards paying the mortgage. This is the principal and interest portion of the payment and goes towards paying down the loan amount. The remainder, or $350, is saved into an escrow account. Every month this account grows, and when the taxes and insurance are due, the servicer withdraws the funds and uses them to pay the bills on behalf of the homeowner. Because the cost of property taxes and insurance adjust and typically go up, even though the principal and interest portion of the payment is always the same, provided, of course, that you have a fixed interest rate loan, if you have an escrow account, the monthly payment you make to the lender could vary and may increase over time. Now, the advantage to having an escrow account is that it helps you manage the payments for property taxes and insurance premiums. If you fail to pay them, the consequences are great. If you don't pay property taxes, the state or local government may impose fines and penalties or place a tax lien on your home. You could also face foreclosure. Now keep in mind the first installment of property taxes is due on November 1st and delinquent after December 10th every year, which is during the holiday season when you have other expenses and budgeting becomes more challenging. If you don't pay homeowner insurance, you risk losing coverage. This means breaching the terms of your mortgage contract by not having homeowner insurance in place, and you might face added costs and eventually foreclosure. So think of it as a savings account. It helps you budget for these large costs, so you don't have to worry about making sure you are saving enough every month to have enough available when the bills become due. Also, because the servicer will pay the bills on your behalf, you don't have to keep track of bill payments, due dates, or worry about missing payments or paying late. Now, the disadvantages to having an escrow account are that your funds are tied up. It's money that may earn you interest if you kept it in a savings account instead. You will likely have to make an upfront payment at closing to set it up, which generally equals 2 months worth of the monthly amount needed to cover the costs for taxes and insurance. And if you want to remove the account in the future, you would need to send a written request to your lender or loan servicer. Whether the request is approved depends on several factors, including how much equity you have. Even if your lender does not require an escrow account, consider requesting one voluntarily. If you choose not to set one up, then you must commit to budgeting your income and expenses carefully to make sure you have the funds to pay your homeowner insurance and property tax bills in full when they're due, and keeping track of bill payment due dates to make sure that you pay on time. Now, if a lender denies your loan application, there may be steps you could take to improve your chances of approval with your next application. So first, understand the reason or reasons why it was denied and address those issues. What can you do to correct them? As you work towards placing yourself in a more favorable position, look at yourself the same way lenders do. If you were denied because you didn't have enough liquid in savings for a down payment and closing costs, can you apply for a down payment assistance program? Look if there are individual development account programs in your area you may qualify for. These are programs that match your monthly savings, typically 1-to-1, and they specify towards what you can apply your savings to, but most commonly, these accounts are to be used to buy a home, education, or starting a business. Some lenders also accept gift funds from family and friends, so ask if this is an option. Keep in mind again that anyone gifting you money would have to agree in writing that this is a gift and not a loan, and you will have to provide proof the money is available. If your income's not enough to afford the housing payment, you may not be able to do a lot to grow your income right away, but here are some possible solutions. The less you borrow, the lower your housing payment will be. Can you apply for a down payment assistance program so you can put a larger down payment? Review your expenses carefully. How many can you reduce or cut so you can free up money that can go towards building savings so you can put more money down? Are there mortgage credit certificate programs you can apply for? These programs reduce your potential federal income tax liability, which creates additional net spendable income that you can apply towards a housing payment. Some loan programs allow for co-signers. However, before considering this, keep in mind the co-signer will be legally liable for the debt. And if you fail to meet your repayment obligation, the lender will go after both you and the co-signer. Also, because it is their debt, it may impact their ability to qualify for credit or loans, including a mortgage loan if they ever want to purchase their own house. And co-owning the home might also prevent them from qualifying for first-time home buyer assistance programs. So you must make sure that the person you ask understands all this and is willing to take the risk. If you were denied because your debt ratio is too high, review your budget. Are there expenses you can reduce to free up money that can go towards paying down your debts, like credit card balances? If you're denied because of a poor credit history, look at your credit report carefully. What can you fix? Are there collections you can pay? Late payment history you can reverse? Errors reported you can dispute? Resolve anything that will show you're a responsible borrower and that helps increase your score. If the application is denied because the home appraisal is too low, can you renegotiate the purchase price with the seller? Now, the Fair Housing Act prohibits discrimination in residential real estate related transactions based on race or color, national origin, religion, sex, familial status, handicap. And the Equal Credit Opportunity Act, or ECOA, prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or receipt of income from a public assistance programs. And watch out for signs of predatory lending. Predatory lenders typically target borrowers with low credit scores or low income, although anyone could fall victim. Here are some red flags. A lender that says your credit problems won't affect the interest rate or guarantees approval. A lender that charges high interest rates compared to other lenders. So before you apply for a mortgage loan, you should research current mortgage interest rates so you can get a good sense of what you can expect. Not all lenders charge fees, but it's predatory lending when they charge excessive fees compared to other lenders, or they don't disclose some fees up front. A balloon payment is one very large payment the borrower has to make at the end of the loan. Predatory lenders offer borrowers a loan with a small monthly payment that only covers the interest and does not go towards paying down the principal portion of the loan. That means that the borrower will own a large amount that they will have to pay in one lump sum at the end of the loan term. If they cannot pay it, they will need to refinance, which means getting a new loan with new fees and costs. If the lender provides you with documents that are missing important details, prepayment penalties are fees lenders charge when a borrower pays off all or part of their loan before the end of the loan term. Lenders can charge a prepayment penalty, but only for the first 3 years of the loan. Also, there's a cap to what they can charge. If the lender's prepayment penalty is greater than 2 years, look at it very carefully. Again, shop around, you may be able to find a better deal. Watch out for lenders who encourage you to borrow more than you should or that you know you can afford. Another predatory practice is changing the loan terms at closing and steering borrowers towards a specific lender or to a certain loan product is considered predatory lending, and it's also illegal. So here's some mortgage loan shopping tips. Focus on what you can afford given your other financial priorities, not just how much you qualify for. When you apply for a mortgage loan, lenders will tell you how much you're qualified to borrow, but they do not consider all your family and financial circumstances. Also, their qualification calculation is based on your gross income, which is not what you put in your pocket and is available to you to cover all your household costs. So it's very important that you take a hard look at your personal expenses and saving priorities, as well as how much in net income you can count on to determine what fits comfortably within your budget. When calculating what you can comfortably afford in housing costs, don't focus just on the monthly mortgage payment. Consider all the costs that come with owning a home, including property taxes, homeowner insurance, mortgage insurance if applicable, HOA payments, costs for repair and maintenance, costs that may increase like utilities, regular upkeep like landscaping if you have a yard or a pool, the upfront costs like the down payment and closing costs. Watch for risky mortgage loan features and consider them very carefully. If the loan offers a balloon payment, you could owe a big amount at the end of the loan, which can be tens of thousands of dollars. You need to carefully think about whether and how you can make that balloon payment when it comes due. Also, if the value of your property falls or your financial conditions decline, you might not be able to sell or refinance in time before the final balloon payment comes due. To make monthly mortgage payments more affordable, some lenders offer loans that allow you to pay only the interest during the first few years of the loan term. However, this means that the amount you owe on the loan does not decrease and you're not building equity. After that period ends, you must repay both the principal and the interest, and your monthly payment will increase, and you may also be required to make a balloon payment at the end of the loan term. Some loans have a prepayment penalty. This is a fee, again, a fee that some lenders charge if you pay off part of your loan or mortgage early. If your loan includes it, ask your lender when you would be required to pay it and how much would the payment be, and ask about other options. Watch out for predatory lending. Red flags that guarantee approval, steering towards specific loan or product or lender, encouragement to borrow more than you know you can afford. Shop around, talk to more than one lender, ask for the same kind of loan with the same feature, and compare loan offers so that you can decide which lenders offer the best deals. Research loan programs. Check with your city and county to see if they offer home buyer assistance programs for people who live within their boundaries. Are there programs that help people work in your profession, purchase a home? The more you know what is available before you talk to lenders, the more equipped you'll be to ask the right questions and ensure that you explore all your possibilities. Now, if you would like help with learning what you can do to reach your homeownership goal, consider reaching out to a HUD certified housing counselor. They can provide step-by-step guidance to help you understand what you can do to financially prepare for homeownership and know the home and understand the home buying process. All right, a quick last knowledge check. Let's see.
Alessandra,
Yeah.
it's 1 p.m. I would like to make sure that we have some time for Q&A because we have
Sure.
7 questions.
Absolutely.
Okay, great.
Would you like to do the Q&A first?
No, I mean, if you have more slides.
No, this is the last slide.
Okay, then go ahead.
We can skip it and go straight to Q&A if you'd like.
That would be great. So we can have 5 more minutes to answer the questions.
Absolutely. Yeah.
Okay, great. Well, thank you so much.
Yeah,
It
you're
was
welcome.
really great information. And we have some questions here.